Welcome to PACE Nation's monthly webinar series. We were on hiatus for about a year, but we're back with a schedule of webinars through December. And I am so excited to kick things off with a brand new topic that we have not talked about as much as we would like to at PACE Nation, perspectives on PACE securitizations. Now that the commercial side has really started to ramp up activity and we're seeing more activity and interest in securitization, there's a lot to talk about. So we've got great speakers today. We'll be hearing from two rating agencies, DBRS and Morningstar Credit, as well as Alexandra Cooley from Greenworks Lending to give us a case study about securitization from a PACE provider's point of view. Just a quick background on anybody who may not be familiar with PACE Nation. We are a 501c3 nonprofit organization. We are funded by foundations and by our members to promote PACE financing in all of its forms. And we do that by providing leadership support, data, events, and other networking opportunities for this wonderfully growing universe of PACE market participants. As a nonprofit, we are a member organization. So if you have not joined us yet, we would love to have you join us. You can see the link below, pacenation.us/register, to see all of the options for membership and learn about the different ways that your contribution will help PACE Nation do all of the things that we can to scale for the industry and advocate for our market players. Our members include corporate sector companies, local governments, other nonprofits, national associations, law firms, attorneys, CPAs, and everybody involved with the PACE marketplace. One of the biggest benefits of membership is gaining access to our member directory. Using the member directory is it's basically a database, the white pages of all PACE players in the nation. So we would encourage you to check that out on the website and join us. This is a quick run through of some of the most frequent activities that we engage in. We really like to put out collateral and data for the PACE universe to use. We are the only organization that collects, aggregates, analyzes, and publishes data from the PACE industry. So that is always available for public consumption on our market data page. And I would also encourage you to sign up for our newsletters and check out our social media, where we're on top of all of the most recent headlines and the most newsworthy topics affecting the PACE world. Today's webinar is going to be recorded, and you can check it out tomorrow on the link pacenation.us/webinar. Right on our homepage, there's a link to that. And you can also view all of our past webinars. We've done a one-year series in 2016 with 12 other webinars that are listed there. And if you have any questions, please feel free to ask them at the end of the webinar. You can type them into the Q&A box, and we'll go through asking our speakers to move through them. So with that, I am excited to introduce Lain Gutierrez from DBRS. Lain, please take it away.
Well, thanks, Alyssa. So let's go ahead and get started. Okay. So why don't we start off with an overview of the residential PACE securitization market. Resi PACE securitization has grown rapidly since 2014, as most of you know, with cumulative issuance over $4.7 billion to date. As you can see in the table, the market's been dominated by three issuers: Renovate America, Renew Financial, and Y-Green, all of whom have been securitizing over the last few years, starting with Renovate's Hero platform in 2014. And notable for this year is that we saw a new issuer access the ABS market with PACE Funding's inaugural private issuance. Issuance volume peaked in 2016 at $1.7 billion and has slowed since then. Based on issuance through May, annualized volume for 2018 is looking like approximately $1.4 billion. As PACE has matured and the California market has become a bit saturated. Origination volumes have slowed, and we would expect to see origination volumes ease further in light of the underwriting requirements recently enacted in California, which we will talk about next. In California, two landmark bills, Senate Bill 242, known as the Skinner Bill, and Assembly Bill 1284, were signed into law in October 2017. Both bills had broad support from the PACE industry and addressed concerns raised by consumer advocacy groups, the banking industry, realtors, and clean energy groups. The Skinner Bill established the following key protections for homeowners: a recorded confirmation of terms call for 100% of applicants to confirm the homeowner understands the terms and conditions of their PACE assessment. It restricts PACE originators from paying compensation to the contractor and prevents PACE originators from telling a contractor the maximum amount of PACE financing a property owner is eligible for. The Skinner Bill also requires PACE originators to report data to local governments regarding the projected energy and water savings, as well as local economic and job impacts. Assembly Bill 1284 introduced some additional protections for the homeowner. Effective April 1st, 2018, it established for the first time income verification and ability to pay underwriting standards, which had not been applied to PACE previously. These were designed to ensure property owners who take on PACE financing can afford their obligations. The law also codified the current underwriting standards widely used by the industry relating to LTV and mortgage and property tax delinquencies. And most importantly, perhaps, it also established a regulatory framework for the industry whereby PACE originators will be regulated by the California Department of Business Oversight, which also regulates banks and finance companies. So net-net, the Skinner Bill and AB 1284 represent far-reaching legislation that cover various critical elements of PACE origination and underwriting. We view the legislation as a strong credit positive for the asset class, for industry participants, and consumers as well. In that collectively, it addresses many of the consumer protection concerns raised over the last year. Furthermore, the legislation also places the PACE industry on par with other consumer finance asset classes in that, first, traditional credit metrics will be applied to assess a borrower's ability to repay. Second, the industry will be subject to regulatory oversight, similar to finance companies and banks. And third, it requires a confirmed terms call on top of previously legislated required disclosure modeled after know before you owe. Overall, we see the new underwriting guidelines improving the overall credit profile of resi PACE pools in California and making PACE look more like other consumer finance asset classes that have been accessing the term ABS market for decades. We would also expect to see a slight uptick in FICO scores as well for PACE pools at the same time, which of course would benefit deal performance. We would also expect, as I alluded to earlier, to see an easing of origination volume as the new income verification and ability to pay underwriting standards will likely eliminate the lower credit layer of potential PACE borrowers. Moving on to delinquency, over the past year, there's been significant media coverage on the topic of delinquency levels for PACE. DBRS published a commentary in February on this topic, looking at performance trends in California. We looked at two sets of data to analyze delinquencies, and we looked at California only, since that is the largest market for PACE. First data set was total levy due and related delinquencies provided by David Taussig and Associates, who's the tax roll administrator for both Renovate and Renew's programs. The second was delinquency data reported in the remittance reports for the HERO funding transactions rated by DBRS. The highlights of the report are as follows. While PACE is a relatively new asset class, there is sufficient data to analyze performance in recent years. The data shows pretty strong performance with very low delinquency levels around 2 to 4% when the first installment is due, declining to less than 1% within 12 months. In California, there are generally 2 delinquency spikes over the course of the tax year. The first spike occurs in December, when the first installment is considered past due, and the second in April, when the second and full year installment is considered past due. In general, we saw PACE delinquency metrics being lower than aggregate property tax delinquencies for all property types, so both commercial and resi, and lower than single-family residential only property tax delinquencies. The data also shows consistent performance and very low volatility across tax years. And in our view, the healthier performance relative to all single-family residential taxpayers may reflect the self-selection of PACE homeowners to improve their properties. So looking ahead now to new PACE markets, New York State recently announced its support for residential PACE as a means to achieve Governor Cuomo's energy efficiency goals for the state. The announcement also indicated that appropriate necessary consumer protections and regulation of PACE administrators in New York would also be recommended. Thus, it is possible that we may see similar consumer protections and regulation in New York as California recently enacted, which we just covered. While uniform consumer protections and regulations across all 50 states is ideal, the fact remains that PACE is state-specific. Thus, each state may have a different legislative agenda, so the asset class may not and probably will not be standardized nationwide. Florida, for example, is a fairly conservative state, so their appetite for prescriptive regulation is probably not the same as in California, so we wouldn't expect to see the California type of regulations in Florida. However, in conclusion, we would hope that originators do in fact apply consistent underwriting standards across states, notwithstanding different regulatory frameworks, as of course that approach would facilitate securitization and make the asset class much easier to evaluate from all perspectives. And with that, I'll turn it back to Alyssa. Thank you.
Thank you, Lain. That was very interesting. Thanks for covering the legislative initiatives going on in California. I would add to that the House Banking Committee federally passed a bill just yesterday that would require the CFPB to have federal oversight of state PACE programs. So we'll see how that plays out with the addendum to consumer protections and legislating that aspect. So next we're going to hear from Stephanie Ma. Stephanie will give us a little more of a point of view about the residential side, the commercial side of securitization.
Good afternoon, everyone. It's my pleasure to be participating today, and I want to thank PACE Nation for hosting the webinar. We hope that the webinar helps to educate market participants about this new emerging sector that we're seeing. Alyssa, I'm just trying to get control of the screen. There we go. Just to give an idea of the scope of the CPACE market, currently there are 33 PACE-enabled states, and that means that they have legislation that enables them to provide PACE programs, and of those 33, 20 are active. We've seen originations across a diverse set of property types. They have run across multi-family, mixed use, retail, office, industrial, healthcare, hospitality. So it's no surprise that in securitizations, we have seen CPACE assets across those same exact sectors where we've seen the origination volume the highest. To date, we have seen about 15 million in CPACE transactions in terms of originations. This is one of those sectors that doesn't fall neatly into your typical structured finance sector. As a result, Morningstar applies a blended approach using facets from both CMBS and ABS. We use CMBS as a starting point and examine metrics such as debt service coverage ratio, lien to value, total debt to value, and property type. We also look at past tax assessments and for the presence of whether there are other existing PACE assessments on that property. Just to give to some perspective, we have seen DSCRs around 1 to 1.2 times in CPACE assets underlying securitizations versus what you would roughly see in CMBS of 2.1 times. LTVs have been in the range of 15 to 25% for CPACE versus what we've seen 7% across our PACE. In addition, we also consider qualitative factors that may impact the stability of the cash flows. These include things like whether it's an esoteric property type, say a church or a hospital, for example. We look at tenancy, tenant concentration, lease terms. Is it a gut rehab or is it a new construction? The property location obviously makes a difference, whether it's in a very rural area versus a metropolitan city. We look at enhancements such as guarantees, insurance, and escrow accounts. The qualitative assessment gets a heavier weighting in instances when the data is insufficient to rely on a model to estimate the probability of and percentage of borrowers defaulting on PACE obligations. We assess the likelihood of repayment of the securities by incorporating parameters such as probability of default, recovery rate, time to recovery, and prepayment rate. The challenge is with the market still being in its infancy, often the specific pool analysis is atypical and therefore will require a case-by-case approach. And in contrast to our PACE, the portfolio's underlying CPACE securitizations are not homogeneous assets. They tend to be very granular and in some cases only involve a single property. However, even though the collateral pools may differ across future various transactions, Morningstar applies a consistent analytical framework. The more information that we are provided, the better we are able to assess the cash flow stream. Formal appraisals and our financials are ideal, but we're discovering that they aren't necessarily always available. As a result, an independent review of the cost-benefit analysis may also be required to determine the project's feasibility. There are a number of unique attributes to CPACE that we consider strengths. The first is non-acceleration upon default. PACE defaults do not trigger accelerated paydowns of the PACE balance, as only the overdue amount is due and payable upon foreclosure. In addition, PACE assessments are likely not a significant financial burden to the property owner, as the maximum lien to values are generally low and are paid over a long period of time, ranging anywhere from 5 to 30 years. The liens are generally not extinguishable through bankruptcy. PACE assessments have an equal lien position with property taxes and are senior to the lien position of a mortgage. The obligation to pay the PACE lien is tied to the property rather than the borrower, as is the case with a mortgage. As a result, any subsequent property owner would be responsible to make the future PACE payments. And then lastly, there's the notion of lender's consent. Morningstar considers lender's consent a credit positive, as most commercial programs require borrowers to obtain mortgage lender's consent before providing PACE financing. Requiring lender's consent imposes borrower discipline on property owners as most of the current PACE programs do not have lifetime limits on PACE financings to date. More than 200 institutions have given lender consent to C-PACE projects per PACE Nation. On the flip side, there are also a number of concerns, however. PACE assets have a limited performance history. With the asset class being relatively new, there is limited historical data on PACE delinquencies, defaults, foreclosures, and recoveries. As Lain noted earlier, California recently passed legislation AB 1284. As part of AB 1284, there's a proposal for the establishment of a PACE registry where program administrators may be required to use a real-time registry or database system for tracking PACE assessments. The Commissioner of the Department of Business Oversight shall determine no later than 2020 whether to proceed with a rulemaking action to require this change. Whether C-PACE providers will also be subject to this possible requirement remains to be seen. But in general, its implementation will increase transparency and allow for the collection of data for performance metrics. The second concern is construction completion risk. Obviously, with any construction project, there's the risk of it being completed on time. You look for guarantees, insurance, escrow, or project managers. Often, if you have an independent project manager, they can make sure that certain milestones are hit to ensure the success of the project. There's also the risk of abandonment. If properties are abandoned, which can occur in the case of a natural disaster, there may be significant lags in recoveries. And then lastly, there's concentration. Unlike our PACE, C-PACE is very segmented and has much smaller origination volume. Across C-PACE assets, we've seen roughly 600 million versus 4.3 billion across Resi. Concentration is by property type and by obligors. The more diversified the pool is, the less reliant the deal is on any one property. In a concentrated pool, whether by property type or region, there is a higher probability of disruption in the cash flow. Liquidity is a primary risk in C-PACE-backed securitizations because of the potential concentration of these obligors and the less certainty about the recovery time periods due to these diverse property types. When the borrowers default, cash flow to the deal could be disrupted, so liquidity risk is mainly associated with the timing and amount of recoveries. So how did we get where we are today in terms of C-PACE securitizations? Morningstar first saw C-PACE assets in Y-Green's Good Green 2016-1 transaction. That was primarily Resi, but roughly 5% of the assets were from commercial properties. The commercial assets were small and granular and similar to Resi. The property types included multifamily, condominiums, which have a relatively more stable cash flow than, say, sectors like hospitals or hotels. The Class A notes were rated AAA. That was the first AAA assigned in the PACE sector. And since that time, Morningstar has rated Y-Green's subsequent PACE securitizations, which have also had underlying commercial assets representing anywhere from roughly to 4 to 6%. Then in September of last year, Greenworks Lending completed the market's first groundbreaking securitization, which was backed by 100% of C-PACE assets. Since it was a private transaction, I'm limited in what I'm permitted to disclose, but I believe Ali will be going into some more detail later on in the presentation. And then earlier this year, we saw the single asset C-PACE securitization. That was the Petros deal rated by DBRS. Morningstar has seen several C-PACE single asset proposals come across our desks. They've run the gamut across many different property types. With single asset C-PACE, the main concern is high concentration risk. In this instance, we would rely heavily on our CMBS expertise to evaluate the risks and perhaps do a site visit. We do not have any rating caps on single asset C-PACE securitizations, but again, they are analyzed on a case-by-case basis dependent upon the specific risks at hand. In terms of Morningstar Credit Ratings C-PACE outlook, based on the deals that we're seeing come across our desk, we can see there's certainly heightened interest on the C-PACE side. We've seen interest in securitizing portfolios of both diverse pools as well as single asset and even single asset new construction, gut renovation, as well as ground up reconstruction as well. According to PACE Nation, about 19% or 37 million of the CPACE funding was attributed to new construction. And if you count redevelopment efforts, which have major rehab or gut renos, that adds another 41 million. So you can see that this market is growing and there's strong interest in it. But as with any growing market, as transaction volume increases, investors have the opportunity to learn more about the sector and get more comfortable with the asset class. Based on the discussions we have been engaging in, demand is strong on both the issuer and the investor side. I think that once we see the first public CPACE securitization, investor acceptance will grow even more. All the other previous transactions that have come to date have been private, and if I had to hazard a guess, I'd say we'd see the first public CPACE in the next coming months. Alyssa, we can turn to Allie now. Thank you.
Great. Thank you so much. That was wonderful, Stephanie. And I must say, I think you're right about anticipating the next commercial securitization. Clean Fund has been putting out a few teasers. So that's something we should keep our eyes open for in the next few weeks even. So I am going to hand the mic over to Alexandra Cooley at Greenworks Lending to tell us a little more about her experience going through a commercial securitization.
Great, thanks guys. And thanks for putting this panel together. So a little bit about Greenworks Lending before I dive into the, jumped ahead real quickly. A little bit about Greenworks before I jump into the securitization. Greenworks is a commercial-only PACE originator, and we were founded in 2015 with the goal of bringing more affordable capital to the commercial real estate market for folks that want to install long-term energy-saving measures, essentially going green, but lack the affordable capital to do that. And as most of us on the phone know, PACE is a really exceptional tool for that market. We got our start in 2015 as a private company, but my partner and I actually came out of the Connecticut Green Bank. And the reason that's important is because, as Stephanie mentioned, there are some unique challenges to commercial PACE in kind of aggregating enough scale to access the capital markets, which is really where the most affordable cost of capital will come to commercial borrowers. So essentially the Green Bank, which actually both my partner Jessica and I started at in 2012, created de-risked the CPACE market quite a bit before any of us jumped in and did any securitization, private, public, or single asset. There were a lot of questions. There had been absolutely no performance, very, very few CPACE assets done in the market. And the Green Bank actually started its own lending program. So not only did we pass the policy, set up the guardrails, as kind of most program administrators on the phone have done, but we also created our own CPACE assets. We received some balance sheets from the state and began lending. And what we were really solving for were a couple of different risks in the market before we knew that it could be a really viable private market. First, there was just absolutely no performance history, as Stephanie mentioned. That's still fairly limited, just given the long-dated nature of the asset and how long CPACE has been around. But when we started, there was literally nothing, and so we began to aggregate payment history, and we developed standardized underwriting criteria so we could really see kind of how the assets performed relative to quality. The other kind of risk is that would anyone want to buy the assets? These are kind of 20-year fixed rate assets in a very dynamic market that changes daily. And so essentially at the Green Bank, we created 2 RFPs for financing to prove that there was a really deep investor base for these assets, even though kind of there was very little volume at the time. The other question was, would anybody want to use PACE? So once we established that there's an investor base, would there be any volume? And so we also developed a kind of test pilot go-to-market strategy for the small to medium-sized real estate market. And then last, could these assets be rated? Could they be sold, and could they achieve the cost of capital that we knew would really drive volume and kind of unlock energy measures for the commercial PACE market? And we were able to execute on 2 asset sales while we were there that really proved that, yes, these could be aggregated, they could be standardized enough to access the capital markets. And so then the question becomes, why did we start the Green Bank, or why did we leave the Green Bank and start Greenworks? And then why did we decide to access the securitization market when we did? And I thought I would focus a little more on those questions because I think Lain and Stephanie did a really great job covering the kind of how of the securitization. So really our goal is to bring the most affordable cost of capital to the commercial PACE, borrowers. And in order to do that, we knew we had to aggregate enough scale, and we knew we had to do that nationally. And so at the Green Bank, we kind of proved the model. In 2015, we started Greenworks, which is a private company. And we started it with the goal of scaling nationwide. And we also kind of freed up the Green Bank to invest elsewhere at no cost to ratepayers. And since then, we're now active in 13 states. We've built up a fairly significant pool of commercial PACE assets. And we completed the first securitization in September 2017, as Stephanie mentioned. Just a quick snapshot of kind of what is currently in commercial PACE pools, and this is fairly representative of Greenworks' portfolio as well. About half of the projects have some sort of energy efficiency measure, and that overlaps pretty nicely with a lot of gut rehabs and new developments will really focus on the gut of the building. So energy efficiency, HVAC, and then on the retrofit side, which tended to be where we've seen the most volume historically, although that's changing quite a bit as we move into new markets. There's a significant renewable energy component. And that's really attractive to borrowers because, of course, solar, for instance, is a really long payback period measure. And so you can pair it with 20 or even 30-year financing. It becomes a very attractive upgrade to your building. And then about 20% has been some sort of combination of the two. In terms of CPACE projects finance, this is just to say that Greenworks has really focused on this kind of red part of the donut. The kind of medium-sized PACE assets. Again, that's skewing a little bit larger, so more towards that yellow part, the greater than $750,000 as we're moving into new markets. But what was kind of unique about what we put together was that it was fairly granular for a commercial PACE offering. We've seen in the market PACE assets as large as $50 million. And those can be quite attractive, of course, but we've really made the decision to focus on the mid-market and the more granular assets. And what that means is we have to develop a much more standardized platform, and that played into some of the reasons we decided to go out to market when we did. And you can see we got our start in Connecticut. That's the second largest state in terms of CPACE dollars funded, which we're always still very excited to see, even though we're now in all of these states that you see on this chart. And just to get into the securitization a bit more, so Guggenheim Securities led the $75 million transaction. The $75 million was the senior note. It was the first rated commercial PACE securitization. And the reason we decided to do it, it's obviously a little bit painful to be first. Stephanie and Morningstar and DBRS had done a lot of thinking around commercial PACE securitizations and methodologies, which was extremely helpful as we were building up the platform. But there are a couple of reasons we decided to just go out and get it done. So first, while there were lots of kind of methodologies published, it was unclear, when you come across an actual asset and you have questions on kind of the underwriting and the platform, how that would actually play out in a rated transaction. And it was very important for us to get our operational platform and our underwriting blessed as investment grade. So to end up going out and getting a rating on our assets. And that was really important from an efficiency perspective. And the other piece, of course, is to decrease the cost of capital to our borrowers. At the time and still, we were in a rising rate environment. And of course, these are 20-year fixed rate assets. So it was important for retaining momentum in the market. We were building out, we are still building out partnerships with energy contractors and referral partners in the market. It was very important for us to bring them stability and to bring our borrowers stability in terms of rates. And so one of the reasons we went out when we did was because we could see that rates were going to increase. And we wanted to make sure that we could ensure stability with rates to the borrowers, and we were pricing appropriately. We were able to achieve a AA rating with Morningstar. And the note was fully purchased by Teachers, which is an affiliate of Lain. It actually reduced our cost of capital by 100 basis points, and again, match funded the CPACE assessments, which was really important for managing our risk as a company, and also allowed us to keep our rates as low as possible, prove the concept, and build efficiency within Greenworks. And then it's always, I always find it very interesting to put some meat on the bone with actual buildings, and these are properties that went into our securitization, and so you can kind of see some details. As Stephanie was referring to, there's a large breadth of property types and borrower types in the CPACE market. So this will give you a sense of the types of borrowers that we see. So the first was a manufacturing company in Connecticut. They're a high efficiency kind of component part manufacturing company, and they really wanted to go solar. So Connecticut at the time had, and still does have, a very attractive incentive that pays out over 15 years. And a lot of building owners really want to get access to that. It's essentially a feed-in tariff, but don't want to commit the capital up front because they want to hire new people or invest in their facilities. And they don't want to commit the capital to installing solar on their roof up front. So this was a really great kind of down the fairway project for us, about $400,000, 15-year term to match the ZREC, and brought them immediate savings in the form of tax savings in year one, and about $640,000 in savings over the life of the system. The second one, this is kind of a Main Street retail store, retail building. Here they were kind of, you can see that they're a little bit outdated in terms of their systems, and they really wanted to reduce their energy costs and attract new tenants. So we helped them install new HVAC and building envelope. It was a very small deal, about $130,000. And they received about $300,000 in savings over time. And this had a very attractive LTV. Many of our small projects do. They have a very targeted measure that they want to install or retrofit that they want to undertake. And then last, I try not to have favorite PACE deals, but this is certainly one of my favorites. This was an old bank building in the center of Hartford, Connecticut, where a developer wanted to turn it into a multifamily mixed-use property, but also wanted to turn it into a microgrid that would island and allow members of the community to come and get prescriptions, take a shower whenever there was another blackout. So in Connecticut, we've had a lot of storms that have been very disruptive. And so the state was really, has been encouraging folks to install microgrids, which allow a building to island and come off the grid if the grid were to go down. This is $1 million project, which went to install solar, battery backup, and other components of a microgrid, and also lighting. This resulted in about 2x of savings. And I'm also happy to report that once we finalized PACE and the building was complete, it's currently fully leased up, which is also really great to see. And then with that, I will turn it back to you, Alyssa, and to questions.
Thanks, Ali. That was great. I always love seeing case studies and seeing the breadth of projects that can all fit into a PACE financing box that works best for them. So at this time, I would invite everyone to type any questions you have into the Q&A box. We'll start out with one. This is for you, Lain. Can you talk about the Skinner Bill's application to residential PACE versus commercial PACE?
Bill and AB 1284, as I think Stephanie alluded to earlier, apply only to residential. They do not apply to commercial PACE originators.
Great, thank you. All right, it looks like we've got 60 people on, but no questions right now. Okay, Ali, you mentioned a reduction of 100 basis points. What are the effective cost of funds?
Yeah, so unfortunately, as Stephanie mentioned, this was not a publicly rated transaction. So unfortunately, I can't talk about our specific cost of funds.
Are you able to talk about the percentage breakdown of the tranches and who holds the equity piece?
Sure. So, so we hold the equity piece at Greenworks. We're a balance sheet lender, and we've been committed to that model since we started. And then I believe that the advance rate is public. So if you Google it, you should be able to find it.
Great, thank you. Question for Stephanie. Can you talk a little bit about the CMBS market? There's a question about why DSCR is lower for PACE projects compared to CMBS deals.
Yes, earlier I noted that DSCRs and C-PACE assets that we've seen so far have been about 1 to 1.2 times versus 2 times, which you normally see in CMBS. It's important to note that there have only been a handful of deals that we've seen so far, and those are the averages around the statistics. That may very well change as we see more activity in the market, but those are our observations to date, based on the properties underlying those transactions.
Perfect. Thank you. I think this question can probably go to anybody to answer. Do the benefits of securitization and the reduced basis points get passed on to the borrowers in any way, and are their annual assessments affected?
Sure, Alyssa, this is Lain here. I could take this one. The short answer is no, because once a consumer enters into an assessment, all the terms of that assessment are locked in. But I will say that the financing costs for PACE in general have been reducing over the past year or so. And so you've seen, and DBRS has noted this in our rating reports for these transactions, that the effective interest rate in these pools has been reduced as the originators have introduced a reduced rate product. So yeah, in that respect, yes, the benefits of lower cost financing are being passed along to consumers.
Yeah, and I can talk about it a little bit from the commercial side. That was one of the major reasons we wanted to go out to market with securitization. And I can say that our rates have not increased in our pool by nearly as much as rates have increased. So we've been able to hold rates far more steady for our borrowers and our channel partners because of the securitization.
Thanks, Ali. There's a question around what, if any, intersection there is between PACE assessments and real estate brokerage laws. Is there anybody who'd like to answer that?
I haven't seen any so far, so I'm not aware of any.
Yeah, okay. I think that's just a touch outside of the wheelhouse of this specific presentation. Morningstar, have you published your CPACE rating criteria, and what documents have you published around PACE rating?
Our methodology for PACE is something that we're actually working on internally, and we expect to publish that in coming months.
And we can find that on your website?
Yes, it will be published for public comment. In addition, we have also published various research pieces on PACE, and that's available free of charge on our website.
Great, thank you. Here's a question that I'm going to direct to Ali. The root of this question is about transferability with commercial properties that have PACE encumbrances. Have you had experience with a new buyer purchasing a property that has an existing PACE debt? And is there any perceived risk along with that?
Yeah, I can say we've seen this a handful of times. And as we're getting more and more into new developments and gut rehabs, this is certainly a conversation that borrowers like to have. At the end of the day, we actually see PACE as a really great option for shorter term owners of real estate assets, because essentially it's a property tax assessment that you can prepay. So to the extent that they come to the end of the time and they find a buyer that doesn't want a CPACE assessment, they're able to prepay that assessment. And that optionality has been extremely valuable for borrowers. Although we have seen a handful of PACE assessments transfer in a sale and not be paid off.
Perfect. I think the rest of the industry would echo exactly that. Question, I think this will probably be for Stephanie, but if anybody else would like to jump in, that's fine. Can you talk about the different considerations between single asset securitizations versus new construction for retrofits versus portfolios with multiple assets?
We've seen securitizations or proposals for securitizations really run the gamut from diverse pools. Obviously, with diverse pools, you're going to have less concentration risk. But we've also seen single asset proposals, single asset new construction. With those, there's obviously heightened risk in terms of, I mentioned earlier, in terms of abandonment and also time to completion. With the new construction, there are all these additional risks that come into play about, will the borrower be able to make that first payment at the end of the day? We are looking at also gut rehabs or renovations where they're doing from the ground up construction, and again, a lot of these transactions, they're really very specific on a case-by-case basis, so we'll look at those individually but still try to apply a consistent framework from an analytical perspective.
That makes sense. Do you have anything to add about the role of insurance on PACE encumbered properties that will be entered into securitization pools?
I think they said it isn't required. We haven't seen it required, but it certainly helps in the transaction because that way there's a fallback. But again, this is an evolving market, and we're seeing really a variety of different types, but it isn't necessarily required.
Thank you. That's helpful. All right. Well, I don't want to grill our generous speakers too hard. I very much appreciate the time that you've dedicated to speaking on our webinar and talking about your experience in this new and exciting market. So thank you everybody for joining us today. This webinar will be posted on YouTube tomorrow, and you can also find it on our website under the webinar link. We will be sending out a link for our webinar next month, which will focus on the role of green roofs and how PACE financing can be used to accelerate the adoption of green roofs on commercial and residential properties. So you can register for that on our website starting next week, and we'll look forward to seeing you then. Have a great afternoon, everyone.